Good afternoon to all of our viewers from across the U.S. We're certainly glad that you could join us today. It is April 24th of 2023. Hope that everyone had a good weekend, and given us the last week of April here, we wanted to address not the market, not the technicals or the fundamentals or a lot of the things that we go through on a weekly basis. What we want to specifically focus on today is gold. Why do we own gold? Why are we overweighted? The role that it plays, and quite simply answering the question of why does gold matter? So we're going to go through three things this week: the role that gold plays, not just in the portfolio, but across the global economy and central bank reserves. Number two, what is a reserve currency, and why is the US dollar so important as it relates to the price of gold? And then lastly, the various factors impacting the direction of the US dollar. Because if you get the US dollar right, chances are you'll get the direction of gold right. Because as we've talked about many times before, what is gold? It's at the end of the day, gold is a hedge against the value of the dominant reserve currency in force at the time. So back in the 1910s or 1920s, it was a hedge against that British pound. Today, it's a hedge against the US dollar. So from 2000 to 2010, dollar down, gold up, reverse from 2010 to 2020, where we saw dollar up, gold down, right? And so the question really is now, after a 10, 12-year bull market for the US dollar, where will it go next? So key question, what is a reserve currency and what drives its value, right? Because if, again, we know that the US dollar is a big influence on the price of gold, and we know it's a reserve currency, but what exactly is a reserve currency? Because given some of the geopolitical backdrop that is taking place right now, and the transition that is taking place, I think it's going to be really important to understand this concept if you really want to understand why you own gold and the role that gold plays. A reserve currency refers to a strong currency, often a foreign currency, not for us, of course, we are the home of the reserve currency, the US dollar, that is used for international trade and to settle international debt and obligations. Now, the second part is important, and this is the one that I put in there, which is another unwritten rule with the reserve currency is that it should act as a neutral store of value that is easily accessible to friend and foe alike. In other words, it doesn't matter if it's Russia, China, Britain, France, the US dollar should serve as an intermediary of global trade and value transfer, regardless of friend or foe. That's how reserve currencies typically work. And we know that the US dollar is important for the price of gold. We went through this chart last week, but I wanted to reiterate this. So we saw in the 1970s, this first part right here on the left, that was a big bull market for gold. And sometimes it gets incorrectly tied back to inflation, right? Gold went up because inflation went up. Gold, in our opinion, went up because US dollar went down. And it was right after Nixon depegged the US dollar from the price of gold. Then we had the 80s, right? And that was when the US dollar ripped to the point where you had to have the Plaza Accord with Japan to devalue the yen. And so what we saw, appreciate the value of the yen. So we saw there it was a gold bear market as the US dollar ripped. That was followed by a gold bull market as the US dollar sank. And then the two big important cycles that we've seen in gold really occurred in the 90s. You had a really significant bear market as the US dollar rallied. Tech bubble was beginning to inflate. And then the tech bubble burst, and we had a gold bull market as China entered into the scene, entering into the WTO. And then, of course, we had about 7 years straight of US dollar depreciation, which led to a gold bull market, and one of the more historic bull markets, mind you. Over the last 10 years, we've had a bear market. US dollar has broadly rallied and has started to peak out. So we want to understand, is this a temporary peak or is this a long-term peak for the US dollar? So what are the forces that impact the value of the US dollar? Now, these are some of the big factors that we've identified. Of course, there are many other factors that can impact price. Cyclical forces such as expansion and recession and how that relates to interest rates and inflation, and we'll go through that here in a second. Number two, competition for central bank reserves. Every central bank can hold their reserves in US dollars, or maybe they hold in Canadian dollars or British pounds or euros or Chinese yuan or Japanese yen. There's competition for central bank reserves. And is that competition increasing or decreasing relative to the dominant reserve currency at the time? Lastly, geopolitical shifts. These occur less often, but when they do occur, it's important to take note, and it can lead to a secular rise or drop in the value of the reserve currency at the time. Now, over the last couple of years, we've seen a very strong rally in the value of the US dollar. Why? Because the Federal Reserve was the first to increase interest rates on the global stage. So what you saw here, so if we look, this chart here on the left, by the way, is the US Treasury 2-year interest rate minus the German 2-year interest rate. So when those differentials widen out, in other words, the US is yielding a lot more than the German 2-year, in a sense, what is happening is people are buying US dollars and selling euros to capture the higher yield. And that was because Europe had negative interest rates while US was hiking its interest rates. So we saw that peak out about August of 2022. And notice what's happened since then. The 2-year yield in Germany has started to catch up to the US 2-year yield. So interest rate differentials started off expanding, helped the US dollar, buy US dollars, sell euros. And now we're going the other way as Europe catches up to the US as it relates to interest rate policy. The other big thing, of course, US, while they were the first to raise interest rates, they may very well be the first to pause or to cut interest rates. And the market's already moving on to the second part of this interest rate cycle. And that's a big part of what's driving the initial cyclical component of the US dollar movement. Another big thing, of course, is the geopolitical transition that we're seeing, right? As great power competition heats up, remember, this is back in 2000, United States, the dominant world power at the time, China still mired as a third world country. That has largely started to change. Russia had just defaulted on its debt. That has largely started to change. The US is now the largest, most powerful player, but within a multipolar world where you have a strong geopolitical rival in China, Russia, which is obviously still trying to recreate that Soviet Union empire, although still largely regarded as declining power, and then the European Union and India. China and India are probably the most important components of this, and then the China-Russia axis together, also a very important player. But why is it important? So we're just going back to this slide real quick, is when the United States is the unipolar power, people are just going to use US dollars because you have what's called Pax Americana, that American peace, because you have one dominant player in the world that's securing sea routes, that's securing global trade. People just use the US dollar as default. As competition heats up and you get rivalries, China and the US are now rivals. China's going to say, well, guess what? Maybe we need to diversify some of our currency reserves away from our chief rival and toward other currencies of countries that are more friendly to us, maybe Brazil or the European Union or India or whatever it is, or our own currency in gold, right? So all of these are things that countries start to ask themselves in a multipolar world. And we know that global GDP is generally shifting south. What we see here is with this blue line is that the emerging markets GDP has surpassed the G7 GDP in terms of total size. And that, of course, means they are accumulating more and more reserves and wanting to diversify those reserves to countries that look more like their own in terms of GDP composition. The other thing to note is that Chinese yuan reserves have doubled in the past 6 years, while offshore yuan bond sales have also tripled. So this is a very significant shift. While the US used to dominate the market for global bond issuance by governments, they would issue in US dollars. More and more governments are starting to issue bonds in Chinese yuan. Third, China wants to expand that BRICS group and boost local currency trade. Again, these are movements at the edge, but they erode market share for the US dollar over time. And then, of course, we've seen what's happened with Russia and the Ukraine war, and we're going to talk about how that's actually a very important point as it relates to the US dollar. Now, we can see here, yuan holdings and central bank reserves have skyrocketed over the last couple of years. Now, they're still pretty small as a total share relative to the US, but they're the fastest growing player in terms of growth of central bank reserves. And then, of course, Chinese or renminbi settled trade or Chinese yuan settled trade has also significantly increased over the last couple of years. So in other words, when there's trade being done between two countries, are they settling those trade transactions in dollars or Chinese yuan, increasingly in Chinese yuan? Now, here's what we think is another big spark as it relates to the US dollar's reserve currency and the need for countries to diversify away from it. When Russia invaded the Ukraine, I think most people would agree that it was obviously an aggressive, Russia was the aggressor in the ongoing conflict. And while it may seem weird to question the sanctions that were put on to Russia, we're certainly not questioning the sanctions. There are implications for it because of the way the US did it. The US basically seized a good portion of Russia's central bank reserves because they were dominated in US dollars. So what happened? The US broke an unspoken rule of reserve currencies, which is to maintain neutrality. No matter how bad your enemy is, or they're the aggressor or the victim, you are a neutral currency, and that's how those transactions take place. So other countries, when they saw that, are now saying, if Russia can lose access to their reserves, it can happen to us if we upset the US. We need to diversify. And that was a big spark in terms of you really seeing this acceleration of what we call that de-dollarization across central bank reserves. And then very short term, it's not helping US credibility with the US debt ceiling debate, right? Now, we know generally between the months of June and August, the debt ceiling is going to come to a head. And what's interesting is that credit default swaps, if you remember our prior conversations related to credit default swaps, that's basically life insurance for your bonds, right? So if I buy some JP Morgan bonds and I want to insure against a drop in the value of those bonds, I can buy credit default swaps to insure against default, to insure against impairment, or whatever it is, and it'll make me whole as a bond investor. So it's basically life insurance for your bond holdings. What's interesting is that you're actually seeing a very significant rise in the premiums charged to buy life insurance for US sovereign debt. This has spiked over the last couple of weeks. And again, do we think the US debt ceiling is going to pass without us paying our debt? No, but it questions the credibility of the US and the US dollar. And we think that is a big setup for gold. We know that the S&P relative to gold continues to trail. The triple Qs, the NASDAQ relative to gold continues to trail. It's one of the first cycles we've seen where you've had a major market bottom back in October and November, and gold is actually up more than the S&P 500 over that time period. That's very unusual. And I think it's a reflection of what's happening at the geopolitical stage. And that is why we love gold so much here. We think that we are in the first year of a multi-year bull market. We think gold is where energy was a year and a half ago, and that's why we're bullish. So as we shift to that multipolar world, we do think the US is entering into a period of secular weakness in terms of US dollar price. That US dollar weakness should, in our opinion, translate into a gold bull market. The competition for central bank reserves is heating up, specifically between the dollar and the Chinese yuan. And we do think that Russian sanctions have served as a wake-up call to many other countries to diversify their dollar-based reserves. So that's why we're bullish on gold, that we think gold can serve as a great component in the portfolio. And we think that we're in the first inning of this. So if anyone has any questions, please feel free to reach out to your advisor. Feel free to reach out to us, and we're happy to answer any questions that you may have. Have a great week and talk to you again next week.